All right, now we are going to move along in this third video for Chapter 7, Cash and Receivables. We're going to start talking about notes receivables. So you've heard of a notes receivable. You know it is a written promise, so it's more official than accounts receivable, that a customer or a borrower will pay a specific amount of money at a future date. It usually includes interest and is more formal than accounts receivable. So accounts receivable is usually just like an invoice that you would send out to a customer. A notes receivable would have like signatures and interest and all that going on. So some of them can be current, and a lot of times they're non-current notes receivable. So in order to be current, it would be due within 1 year, and for it to be non-current, it would be due after a year. Shocker, right? So interest-bearing notes. Now, what we're going to focus on now is going to be where they're paying in the final payment the principal and interest. We'll see later installment loans, and we've looked at those some already, but we'll focus more on those later where it'd be more like a mortgage or a car payment. But here we're talking about where the final payment has all of the interest and all of the principal being the amount that you borrowed. So in order to calculate how much the interest is, you take the face amount, the amount that was borrowed, times the annual rate. So anytime you're given an interest rate, it is for the year, it's for a yearly amount, times the amount of time. So this could be for 3 years, or it could be for 6 out of 12 months. So you would just do half a year, because anytime it's an interest rate, it's for the whole year. So you have to consider, if it is a short-term notes receivable and it's less than a year, they won't be paying all of the interest. So let's jump into an example with Hillbilly Hairdressers. They performed a deluxe possum perm for a local county fair contestant who couldn't pay right away. On July 1st, they accepted a 90-day, 8% interest-bearing note for $3,000. Very important, the 8% is for the entire year. Since they're only borrowing it for 90 days, they will not pay a full 8%. So we'll take that same calculation, the 3,000 times 8%, but then we'll just take 90 out of 360 days. We use 360 when we calculate time. It's like a banker's year. Instead of 365, we just make it an even 360, as if each month had 30 days. It just makes the calculation more even. So they're only going to pay $60 in interest because they're only borrowing it for 90 days. If they were borrowing it for the whole year, they would be paying a whole year's worth. So total, they'll pay the $60 in interest plus the $3,000 in principal. So they'll be paying back $3,060. The customer will be paying Hillbilly Hairdressers. So that means whenever it comes due, the payment comes due, it would be cash, would come in to Hillbilly Hairdressers for $3,060. Then we would be getting rid of the notes receivable. Obviously, we recorded the notes receivable on July 1st when this took place, and they would show interest revenue for the $60. So the original entry back on July 1st would have been a debit to notes receivable and a credit to revenue in this case for the $3,000. Now, because we gave them a loan and it had interest, we get to also show $60 of interest revenue. So we've got the same situation here, but there's a slight change because it is December 1st. So the last one, that was July 1st. So it all happened in 1 year. This one is 90 days, but it starts December 31st. And assuming the end of the year for them is December 31st, the end of the fiscal year, the financial year, we are going to not just record the $60 and the $3,000 when February comes around, but we are going to have to go ahead and record an accrual at December 31st showing that we have accrued some interest. So December, we take the 3,000 times the 8%, the annual rate, times 30 out of 360 days, because it's 1 month's worth, which is going to be $20 of interest. So that $20 of interest, we are going to debit interest receivable, credit interest revenue. That should be 20, not 200. So we got to make sure it balances. That definitely does not. So, but zeros, right? Like, why would a zero matter? It matters when it's on the right hand side. So we would have originally on December 31st recorded our notes receivable for 3,000, and we would have recorded the revenue for 3,000. Now when December 31st comes around, we have to go ahead and record the 30 days worth of interest. So that would be 30 out of 360 days, $20 worth. Then when the loan is due after the whole 90 days is up, they still are going to receive cash of $3,060. That we're going to get rid of the notes receivable for $3,000. The interest revenue is not going to be the full 60 because we already showed interest revenue of $20. So now we're just going to record the 40 for the last 60 days that happened the following year, and then we'll get rid of our interest receivable. So total, they are recognizing the $60 of interest revenue, but they did some in the first year and some in the second year, because with accrual accounting, we have to do that. You might say that's just silly. It was $20, but it could be on a larger scale. They might have lots of different loans. So it could definitely be a material amount. And we have to make sure that we are using accrual accounting and we go ahead and show, hey, we earned $20 worth of interest in that first fiscal year. We go ahead and show that even if the payment is not due until the next fiscal year. So it adds a little bit of confusion, but it's super, super important for you to pay attention to dates, because the question looked completely the same except for that date, and it really changes everything. All right, what about a non-interest bearing note? You've probably heard of a non-interest bearing note. Maybe you've gone to a furniture store, you've seen a commercial, and they say, we don't even charge you interest. You don't have to pay it off for 2 years and there's no interest. Well, the you know that's not true. Okay, so what is a non-interest bearing note? It actually does have interest in it. It is not free money. Instead, they just included the interest in the price. So if you buy furniture and it's like, oh, well, there's no interest on this for 2 years, they've just put the interest into the price of the furniture already. So as accountants, we are wise and we know that people aren't just giving away free money and saying, oh, we don't want to charge you interest, we're so nice. No, they just included that interest in the original price. So for that reason, we are going to have to consider the present value in this. So that's going to bring us to a discount on notes receivable. It represents the future interest revenue. We still are going to show interest revenue if we are giving a non-interest bearing note. We're the ones doing it. So we are still going to show that interest revenue. If we're the ones who have a notes payable and it's non-interest, we're going to have to show an interest expense, and we'll see that later down the line. So it is going to be a contra account to notes receivable for that discount. So let's look at it. July 1st, Hillbilly Hairdressers accepts a 6-month, $5,000 non-interest bearing note. Hillbilly Hairdressers not even charging interest. But the market interest rate is 10% annually. That's pretty high, but it makes the numbers a little easier. So the $5,000 times 10% for half a year, it's only for 6 months, would be $250 in interest. So what we are actually going to consider that we are lending them is $4,750, and then the $250 is interest. So we're really just loaning them $4,750. So we put a notes receivable for the full $5,000, but then we're going to show a discount for what the interest we actually are including in there. We're just trying to sneak it in there. We're going to go ahead and put that interest at $250 as this contra account to notes receivable, and then we show sales revenue for the difference, the $4,750. And you may see a problem that says, the value of this product or service was actually $4,750, and that will help you as well to say, oh, okay, so 250 of it was really the interest. They were just trying to hide it. So, okay, that was the entry they make on July 1st when this happens. Well, what about when it comes time to pay it 6 months later. They're going to show the discount on the notes receivable, getting rid of that contra account. So we get rid of the $250 and we go ahead and show it as interest revenue. So that $250 actually is interest revenue. We just showed it as a discount. And then of course the customer will pay like they said they would, and we'll show $5,000 of cash coming in, and our notes receivable will be gone. So you could put that in one entry, or depending on how your homework's asking for it, it may want it in two separate ones like this. And sometimes they want two separate just to kind of make it really clear and make it easier to follow. So what about the effective interest rate? So they say, hey, 10% is what we were actually including 10% in there. That was the market interest rate. So if there was $250 of interest on really $4,750, that would be like 6 months worth of interest being 5.26%. That was for 6 months. So if we multiply it by 2 to get to a year, or you could have done 12 over 6 months, that means the actual interest rate was 10.52%. So when they say it's non-interest bearing, they're actually charging even higher interest rate than what you would have gotten in the market, because they're not even lending you as much money or whatever it is that you're buying as what they are charging you. So you see, we were using 10%, but because they weren't actually selling you something for $5,000, they're only selling you it for $4,750. The effective interest rate is 10.52%. So they really were sneaky, or we really were sneaky for doing Hillbilly Hairdressers accounting. All right, so we have if it's August 1st and they accept that 6 months, then we are going to go ahead and show the discount on notes receivable of $208 for the 5 out of 12 months. So the last one was saying that it was July 1st, they pay it December 31st. If all of this happened, but it was on August 1st, we're only getting 5 out of 12 months in. They're going to take that 5,000 times 10% times 5 out of 12 months, and they're going to show the discount on notes receivable on December 31st of $208. So in other words, just like we did with the other entry where we saw that with accrual accounting, we have to go ahead and record our interest revenue, they're doing the same thing here. They're taking 5 out of 12 months. So it's the same idea. They just are taking 5/6 of the discount. And then on February 1st, they are going to show the last month, because they have that final month to show the discount and to get rid of the discount and show interest revenue. And then of course, on that date, they would also collect the $5,000. So the only thing different here is this happened 1 month later. And since it was still a 6-month loan, it was not going to be paid till February 1st. So they went ahead and had to show interest revenue December 31st for the first 5 months. So let's talk a little bit about financing with receivables. So sometimes a company needs some financing, they need some money, and the best way for them to do it that they find is to use their receivables as some kind of collateral. So they're secured borrowing. This is where they pledge accounts receivable as collateral for a loan. So in other words, we need to borrow money, and the bank says, or wherever they're borrowing, whatever financial institution they're borrowing from says, well, we need some kind of collateral. We need something to come after if you don't pay. So when they pledge their accounts receivable, they're saying, well, if we don't pay, you can have our accounts receivable. And we're going to look at a few different ways that this can happen. If that's the case, if they do it this way, their entire accounts receivable balance will serve as collateral, so they could come after everything. But the company, like Hillbilly Hairdressers, is still responsible for collecting those receivables. So it's not shifting to a collection company in this case. Now, they can sell their receivables. That is where they are actually saying, like a lot of medical institutions do this, where they say, okay, we have all these people that haven't paid, and it's been 6 months, so we are going to sell these off to a collection company, and they're going to pay us a small percentage. I keep hitting the microphone, I'm sorry. They are going to pay us a percentage of the receivables. So maybe if they're really old, then they're only going to pay them 25% of what the receivables are worth, because now the collection company has to do all the work and they know they may not ever collect it. Or maybe it's still new receivables, but they just need cash soon, and so they sell it off really early and they get a much higher percentage. There can be a gain and loss on this, so it's a similar treatment to any other asset that they're selling. So pledging versus assigning. Pledging is where the receivables work as collateral, so something that the institution can come after if they don't pay the loan. But that means that that institution, that company that has the receivables, like if it's Hillbilly Hairdressers, then they keep all of their accounts receivables on their books as assets. It's only if they don't pay the loan back that financial institution can come after them. Otherwise, they keep everything. It's just there just in case. Kind of like your house. If you don't pay, the house is yours. It's an asset on your balance sheet. But if you don't pay, then the bank comes after it. So otherwise, it's all yours unless you don't pay. Assigning is where they are specifically selecting certain receivables, and that gives the lender the right to collect them. So again, they're going to say, okay, these receivables are 60 days or older. These are the ones that we're going to assign to this. It's not just going to be all of the receivables. And sometimes this happens, as they see that they're riskier or it's past a certain date. Okay, so we're going to jump into an example. We've got Hillbilly Hairdressers. They need $8,000 to buy a new salon chair setup. That seems like an expensive salon chair for that little tiny building that they're cutting hair in. But they decide to assign, so they're selecting specific accounts receivables, $10,000 worth of their accounts receivables to the bank. So the bank agrees to lend them the $8,000, and they're going to charge them a service fee of $200. And there's going to be interest of 10% to be paid when the receivables are collected. Hillbilly Hairdressers will continue collecting from customers, but then they will forward the collection to the bank. So it's not the bank's responsibility to collect it. It's still Hillbilly Hairdressers, but then as soon as they get it, they have to go ahead and forward it. So the initial entry, they're going to show the cash coming in of $8,000. They're going to show the finance charge expense that was just listed there of $200, and then they have to pay back the $8,200 over time. Hillbilly Hairdressers then collects $6,000 1 month later. So that's great. They've already collected a big majority of it. And they're going to show the cash coming in from the customers for $6,000, and they'll get rid of their accounts receivable, but then they have to turn around and give it to the bank. So they are going to show notes payable of $6,000 coming off the books. But they're also going to show interest expense because now 1 month has passed. So we've got our $10,000 they borrowed. That's the $10,000 that the assigned amount. That's what they're going to be basing it off of. The $10,000 times the 10% interest times 1 out of 12 months, they have $83 in interest. So remember, we're using the amount that they assigned of their accounts receivable, not the amount of cash that the bank allowed them to actually have. They use the amount assigned. So that makes it a higher rate there. And then they pay in cash all the receivables they've collected plus that interest. So with the sale of receivables, they're actually going to get rid of them. They're going to remove those receivables from their accounts. They are going to recognize the fair value of any asset required or liabilities assumed, and they're going to record the difference as a gain or a loss. So if they actually sell the receivables, they are done with them. They're getting them off their books, just like you would see any other asset leaving, and they're going to show the fair value compared to what they got in cash, and they're going to show a gain or loss for that. So this is where they're actually selling those receivables. Finally, let's talk about special purpose entities, and we're going to wrap up really soon with this video here in just a minute. So special purpose entity, or SPE, is what's sometimes used whenever a company is going to sell off their receivables or going to borrow money in some way. So if they want to use a special purpose entity to buy, then they're going to use trade receivables, credit card receivables, loans, and they can do it all within the special purpose entity within their business. Or they can sell within that. They can use this to sell bonds and to get some financing, or commercial paper, another type of borrowing. So factoring is where we are going to be using our accounts receivable to get some money again, but it can be with or without recourse. If it is without recourse, this is where they have sold their accounts receivable, and the factor, the collecting of the accounts receivable, that they're going to bear the risk. So the collections agency, if they purchase the accounts receivable, they bear the risks. If the customer doesn't pay. Hillbilly Hairdressers is not liable for any bad debts. The receivables are truly sold. They're like, here's our customers that haven't paid yet. You give us some money in exchange, a percentage of what they owe. If some of these customers don't pay, we have no responsibility. It is without recourse. But if they sell it with recourse, that's not as good of a setup for the seller of the accounts receivables, because the seller still retains the risk. So if Hillbilly Hairdresser sells this to a collection agency and they can't collect, they are going to have to still come up with some of that money. So if you had to get into one of these agreements and you're the seller of the accounts receivables, it'd be best to do it without recourse. If you're the one buying the accounts receivable, it'd be best to do it with recourse, but they're usually going to charge less of a fee if it is with recourse. So let's finish up with a little example here. Hillbilly Hairdressers decides to factor $50,000 of their accounts receivable without recourse to improve their cash flow. So the factoring company says that they will buy the receivables without recourse. So they're not going to come back to Hillbilly Hairdressers saying, your customers didn't pay, give us more money. They can't do that. They advance 90% of the receivables in cash. So 90% times the $50,000, they get $45,000 for this. That's a high percentage. They charge a 3% fee on the total amount factored. So the whole $50,000, not just the $45,000, they have to pay a 3% fee. The remaining 10%, the $5,000, is withheld and may be paid later, which they call a holdback, but the fee is deducted now. So the fee is still on the $50,000. So this is what the journal entry would look like for Hillbilly Hairdressers when they factor it under these terms. They would show cash of $45,000. They're going to show that they still owe them. That they're getting rid of, the $50,000 of accounts receivable. So we see that on the credit. They're getting rid of that. They're only getting cash for $45,000. The receivable for the loss on sale of receivables is going to be that $1,500, and the receivable from the factor is going to be $3,500 to balance it out. Okay, now same exact situation, except this one is with recourse. And they estimate the fair value of the recourse obligation is going to be $2,000. So they'll probably have to come back to get the $2,000. So the entry changes a little bit. They're going to still get the cash of $45,000. They're still going to get rid of their receivables for $50,000. But we see the big change here. We have the same receivable factor, the $3,500, but the recourse liability that we assume we're probably still going to have to pay is $2,000. So then our loss is going to be bumped up to $3,500. Okay, so we'll stop there. I have one more video for this chapter. We're going to talk about some bank reconciliations and some other things to wrap it all up, but you're doing a great job. Just stick with me. Make sure you subscribe so that you don't miss out on any of this fantastic accounting information.